welcome to Shadow of Truth with your host, Dave Kranzler from InvestmentResearchDynamics.com and Rory Hall from thedailycoin.org. And today is Thursday, March the 19th, 2015. And our special guest today is John Titus from Best Evidence. Well, I have a question for you, Dave.
Yeah.
If I were to stop using the word patient or patience, how would that affect your personal economy?
Wouldn't make a damn bit of difference.
Oh, it wouldn't make a bit of difference. So if the Federal Reserve stops using the word patient or patience, how would that affect the overall American economy? Or how should it?
It's not going to make a bit of difference.
Oh, it's not going to make a bit of difference. Really?
Nope.
Well, why does Wall Street think that it will?
I don't know what Wall Street really thinks. I mean, what we saw yesterday in response to the FOMC policy statement was nothing but a bunch of computer algorithms and HFT trading going on. It was absurd.
It's ridiculous.
I mean, why, if our economy is so fragile that everyone's worried about a 0.25% raise in interest rates, then we're in bigger trouble than everyone realizes.
I would have to agree with that.
Because that's what we're talking about here. Even if the Fed were to raise interest rates, and even though they remove the word patient from their policy statement, it's like, who cares?
Right.
Because they wrote the statement in a way that told us they're not raising rates this year. In fact, I personally don't think they're going to raise rates at all. They can't.
They can't. That's the bottom line, is that they cannot.
That's right. If they were to raise interest rates, 0.25%, 0.5%, whatever, just the markdown that would occur on the Fed's balance sheet with all of the Treasury and mortgage paper that it owns would take the Fed's net worth negative. So that would mean that the issuer of the U.S. dollar, the Federal Reserve notes, is technically insolvent. They're not going to do it. They're not going to raise interest rates. If anything, I think they'll figure out a creative way to take nominal rates negative.
Well, let me ask you this. Isn't the Federal Reserve insolvent anyway? I mean, by design? I mean, they never had any working capital. Because
they
when
can
they
print
were
their money.
That's my point, is that they don't have anything. They don't own anything. I mean, they do now, but at the inception of the Federal Reserve System, they owned absolutely nothing. They had nothing except for the backing of the criminal banking cabal that said, we're going to sell currency to the United States government at interest. And that is, so from their very foundation, they were insolvent. Or am I not getting that right?
I don't know. I'd have to think about that.
I mean, right? I mean, but that's I feel like I'm on the right path.
Well, as long as the rest of the world is willing to accept and transact in dollars, they're as solvent as they want to be, because they can just print more money if they need it.
That's exactly right. So it's an illusion. It's merely an illusion, because they didn't own anything when they were born. The only thing that they had was a group of criminals that met in secret on Jekyll Island in 1910 and decided to write a law that said, we are going to take over the Treasury Department by way of this dollar, period. And they convinced the sitting president, I believe it was Wilson, is that right? Was it Woodrow
Yes.
Wilson? Yep. That to sign the Federal Reserve Act. And that was on December the 23rd, 1913, when everyone was away from the office for Christmas break, and he signed it in secret, basically. Now, it wasn't in secret, wasn't behind closed doors, but there was nobody around to stop him.
Yes, and actually, after he left office, he issued a statement, or maybe it was in his memoirs, where he basically said that he fears that he signed away the future of this country, and he
knew.
regretted authorizing the Federal Reserve.
He knew.
Yeah. Well, the whole thing is based on the old adage that Lord Rothschild, I think it was Meyer Amschel, one of the Rothschild criminals, who basically said, if you give me control of a nation's currency, I care not who makes the laws. And that's basically what our system's morphed into.
Yep. Couldn't agree more. So I'm going to go back to my original question. If I eliminate the word patient or patients from my vocabulary, how does that affect your personal finances?
It doesn't affect it at all.
Okay. And if I go bankrupt, how does that affect you?
Doesn't affect me.
Okay. Well, why don't we allow J.P. Morgan and Bank of America to go bankrupt the way that they should have back in 2008?
I said it from the beginning, they should have let them go bankrupt. And we probably would be, our economy would be, and our country would be on a completely different track right now. It would probably be closer to being on the right track rather than completely off the rails.
Or we would have already been through all the pain and everything that is associated with it. But now when it happens, it's going to make that look like a walk in the park.
Yes, I agree.
Why don't we bring on Mr. John Titus and get his take on what's going on?
Rory, with us today is a guy by the name of John Titus, and I've known John for probably close to 3 years, and I can say that he's probably done as thorough of a digging into searching for what's really going on as anyone I know. And he just started up a YouTube channel called Best Evidence, and he has 2 mind-blowing videos. One's called Who's Blowtorching American Jobs? And it talks about how the QE is actually damaging our economy and it's not helping at all, that it was put in place to bail out the banks. And then his latest video is a video that exposes the lies Bernanke told when the system was about ready to collapse in 2008 in order to coerce Congress into coughing up $700 billion in taxpayer money, which essentially was used to bail out the banks and let them pay their bonuses at the end of 2008. At any rate, John digs into Federal Reserve and government documents more deeply and more profoundly than anyone I've ever seen, and he does it from the viewpoint of being a highly trained patent attorney. So in other words, he's willing to do a lot of the digging and research that would cause most of us to have our eyes glaze over before we even got halfway into it. So I'm very pleased that he's agreed to come on our show, and I think listeners will find it fascinating. He's also shown exactly why the government's monthly jobs report is completely fictional. And his first video shows exactly what's going on with the real employment picture, which is basically that the real employment rate's well over 20%.
Well, we'll put a link to his videos below down in the description.
Yes.
So, well, let's get John on and get him to explain it. We're going to pick up right where we left off with the conversation that Dave and I were having, which we were talking about the criminal Federal Reserve, and I'd asked Dave if the word patient or patience would have any effect on his personal economy, and remarkably, he said it wouldn't. And what are your thoughts on John? What are your thoughts on what happened yesterday as far as the market reaction and the FOMC meeting and the criminals coming out to bless us with their presence?
Well, it's par for the course. The market is completely detached from reality. It is completely manipulated. You can see this by looking at Eric Scott Hunsater's, and he works at Nanex. I guess he's the founder of Nanex. His Twitter feed is quite entertaining because it just documents day after day and minute after minute the complete manipulation of the stock market, including yesterday when the dollar flash crashed about, I think it was an hour and 24 minutes after the minutes came out, just plunges, and the market, the stock market rallies, whatever it was, 400 points. I mean, it's insanity what's going on. I don't know how anybody in their right mind could be in this market. You'd have to be crazy to get into this. I got out a long time ago.
Me too.
Because it was so something, and I couldn't put my finger on it back then. And by back then, I mean, early '08, when I saw a problem at the very end of '07. But it's just, and the manipulations just got worse. It's one of those things where when you first see the manipulation, when you first see a problem like that, it turns out to be the thin edge of a wedge, and it's only going to get worse. And so the cover-up just goes on and on and on and on and gets deeper, deeper, deeper. And now you've got a situation where essentially every price in the U.S. is manipulated, with the possible exception of prices on the grocery shelf. I trust those because they're written down on paper. But everything else, if it's a digital price, I'd roll my eyes.
Because it means nothing.
No, it doesn't mean anything. It's not. It's just so far detached from fundamentals. When I would invest in stocks, and I did really well in the stock market, and that was really kind of my number one hobby for a long, long time. I would look at stuff like price earnings ratio and cash flow, and whether they were paying a dividend, and whether the dividend was paying over time, increasing over time, and I would look at it, whether the stock was undervalued, and there were any number of metrics that you could use to see whether a given security was undervalued, what they would call in horse racing an overlay. And those fundamentals they're ancient history. They just don't matter anymore. I mean, look at the price of Facebook, or even Amazon, or any number of companies. There's no connection to reality anymore. It's almost like being in March of 2000 again with the tech stocks. And you point out to somebody, well, eToys doesn't have any earnings. They don't have a product. They don't have any revenue. So why is the stock trading at, whatever, $200? And people are like, well, it's the internet, man. You got to get with it. And that theory works until it doesn't, and it stops working, unfortunately, when you get clocked in the back of the head by a 2x4, and by then it's too late. So good luck to the people who have the stomach for this. I don't, and I haven't for a long time, and I've been out for a long time.
Just to sort of add to what you're talking about there, John, I mean, you mentioned that you were looking at things like PE ratio and debt to capital and cash flow. And the thing of it is, I mean, let's assume you were doing this 10 years ago or 15 years ago. The accounting standards have changed so much, including right after the great financial collapse, when they really opened up the floodgates for misleading accounting.
They took the gloves off. They took the gloves off after the crisis.
Exactly. But, I mean, if you were to apply, say, the accounting standards that were used in 1990 to today's financial statements, I bet half of the companies in the S&P 500 wouldn't even show net income. Oh,
that's certainly true. I mean, if you use those accounting standards, all of the banks, the major banks, would have been wound down a long time ago.
Exactly.
A lot of people say, and they're partially correct about this, that the stock market has made this terrific run ever since the Fed started ballooning its balance sheet and exploding the U.S. monetary base. I'd say that's partially true, because if you actually look at the chart, if you put a chart of the S&P 500 right above a chart of the Fed's balance sheet, what you would see is there was about a 6-month period of time between September of 2008 and March of 2009 where the Fed balance sheet is going up, but the market's still heading down. And it wasn't until, so the correlation is there, but the correlation doesn't start until March. And what happens in March is that's when Congress said, okay, well, we're going to do away with mark-to-market accounting, FAS 157 and all that. And when they dispensed with that and they tip their hand when Obama comes out and says, boy, now would be a good time to get in the stock market. I'll tell you, those profit to earning ratios are looking really good. And it's like, the profit to earning ratios, really. I thought the profit to earning ratios were always 1.000. But that's really when it took off. I mean, he's totally scripted. He's reading the script. He obviously doesn't understand. And that's when the market took off. And that's exactly when mark-to-market was repealed. And it's really the divorce. What you're seeing in the stock market is fiction based on the abandonment of decent and noble and honest accounting standards. So basically, the run-up in the S&P is really nothing other than a fairy tale, coupled with, whatever $4 or $5 trillion that the Fed is pumping in through its terminals at the New York Fed.
I called it all an illusion a minute ago, just before you got
it
on
is,
the call.
but I tell you though, Rory, and that's a really good term, but it's a very seductive illusion because it comports with so many people's reality. I mean, they look out and they see the stock market going up, and they look at TV and people are arguing about things that seem to be real. But it is a great illusion, but that illusion has a plausible overlap, enough of an overlap with reality on the ground to be somewhat plausible. So that the casual observer simply has no chance of figuring out that the manipulation is epic. It's actually planetary now. And the most 99% of the population is just absolutely asleep in front of the television, and they're living in a dream world. And that dream world, though, is, like I said, it does comport with and consistent with the stock market run up. But that's really all they have to point to. Once you start probing into the data, particularly in the labor force participation rate, and measures like that are more difficult to manipulate. That's when the story starts to come apart at the seams. Once you kind of dig even a little bit under the headlines, the story falls apart, right? Whereas maybe 5-6 years ago, you had to kind of dig really down deep to figure out, well, why are these mortgage-backed securities? What are they, and why is Merrill Lynch dumping them in the summer of 2008 for 20 cents in the dollar? You actually had to dig. Now you don't have to dig that much. Just a little bit of digging, and the fiction comes completely unraveled.
So they just don't care, or
well,
why is that, or is it just so, or manipulation is so thick that it can only that it's just residing underneath the surface?
Well, I think that the elephant in the room, to me, if you look at all these different government reports, if you look at the Office of the Comptroller of the Currency, every quarter they come out with a derivatives report. And all you need to do is to click on that report, it's a PDF, go down about 3/4 of the way through the report and look at Table 1 and Table 2 of the derivatives holdings. And those numbers are simply not to be believed. I mean, Citigroup in the most recent report holds something like $70 trillion of notional in derivatives. And I know everybody says, well, that's notional. You don't know what notional is. Okay. I'll tell you what notional is. It's about 1% of the total. So, 1% of 70 trillion is 700 billion. Do you think the Citigroup has $700 billion on hand? No, they don't. And those numbers they're just incredible, and they just get bigger and bigger and bigger, and they're all gambling debts, right? It's just people making wagers and selling their wagers to, I don't know who they're selling to now. I mean, we've run out of Norwegian fishermen pension funds, so I don't really know where they're going. I know that the debt keeps increasing, and that all of those debts are tied to people's bank accounts through legally, right? I mean, when those debts start to not pay off, and the tab comes due, and somebody starts to falter, the counterparties have a legal right to reach into their counterparty's bank accounts, right? And that's really where the rubber meets the road. But the fiction What's driving the fiction is, to me, it's in those charts, those tables, right in, I mean, they're in their face out in the open, in the Office of the Comptroller of the Currencies quarterly derivatives report. It's right there. Just look at the numbers. You can't even find comparable numbers in any other government report. You'd have to go to the Bureau, the Bank for International Settlements, and look at its derivatives report, which puts the total at something like 694 trillion. You know, the U.S. total is something like 300 trillion. So it's roughly half of the entire global market. But those numbers dwarf anything else. I mean, U.S. GDP is what, 18 trillion?
If you believe the number, yeah.
Yeah, I mean, okay.
And that number in and of itself is rigged because it's using an inflation, a GDP deflator that's way too small. If you used a real inflation number, you'd probably take the GDP to under, well, actually we did this exercise. Paul Craig Roberts and myself and John Williams wrote an article. And if you just go back to 2000 and use the appropriate true inflation deflator, it takes your GDP to under 10 trillion. That would be real adjusted GDP.
Yeah, okay. But it's still dwarfed.
Yeah, just Citibank or JP Morgan individually have
by themselves,
right, have derivatives outstanding that are many multiples of the U.S. GDP. And just to blow a hole in that notional is irrelevant argument, well, it becomes irrelevant once you have a big counterparty default, and that's what happened in 2008. How irrelevant was the blow up in 2008? AIG defaulted on derivatives that Goldman Sachs was holding. AIG was Goldman Sachs' counterparty, and if we had just let the whole thing play out, AIG and Goldman Sachs would no longer be in existence.
Correct. And
as you point out in the most recent video that you did, maybe you can talk about that. Ben Bernanke, as leader of the pack, went around and lied to everyone in order to get Congress to allocate the $700 billion that was used to bail out Goldman Sachs and AIG and all the other big investment banks.
Right, and a lot of people got suckered by that story. And so the story is, TARP is this, it's like the mighty TARP mouse, right? Here he comes to save the day. It didn't save the day. It saved Wall Street's bacon for the bonus season that year, but that's all it saved. It didn't do anything else. And I don't know why Bernanke hit the panic button. I have theories. You know, maybe he was threatened. Maybe he had drawn too much money from the SOMA, what's called the open market system, open market operations. He had taken too much money out of those accounts. Whatever. He hit the panic button. He convinced Paulson. Paulson saw his panic. Paulson didn't know any better. And those guys flipped out and made up a story that's just pretty crazy, and it's verifiably false. And the story was that Main Street was in big trouble, and then unless we have $700 billion now, the whole, Main Street's going to be destroyed. We're not going to have an economy. We're not going to have commercial paper. And none of those stories has ever checked out. Every single story those guys have tried to tell, and I think this is why they try to keep the stories as vague as possible, because to the extent they get into details, they get tripped up and they get proven false again and again and again. Like, I'll give you a good example. Paulson came out and said, we have to have $700 billion now because we've got to buy these toxic assets. And if we don't buy the toxic assets, we're going to have martial law. There's going to be tanks in the street, and the system, as we know, is going to be over. Well, as it turned out, of course, they didn't use TARP money to buy toxic assets. And now we know from the AIG trial, from the testimony of Scott Alvarez, the GC of the Federal Reserve, testified in open court under oath that they knew all along, the Federal Reserve knew all along that Paulson's whole story was completely bogus. They never intended to buy toxic assets. But the point of all this is that when Paulson said, if you don't do A, which is buy toxic assets, then B is going to happen. Well, they didn't do A. They never bought the toxic assets, and there was never martial law. So obviously, that story doesn't really check out either. So every story that these guys floated for why they needed $700 billion TARP has never checked out. And to this day, no one has ever explained why that money was needed. No one has ever explained credibly what was going on and why they needed $700 billion then. And the only the leading candidate for that explanation is, well, Wall Street's bonus season was coming up, and they needed to pay bonuses. And with Citigroup and Merrill Lynch both posting, I think it was $29.9 billion losses each that year, record-breaking losses, there was no money to pay the bonuses. So they needed cash from the Treasury, and they got it. Bottom line.
I agree with that. It definitely was used to pay bonuses, but it was also used to save Goldman Sachs and AIG from going under. And Hank Paulson knew exactly what was going on. As the former CEO of Goldman Sachs, he knew what the exposure was, and he knew what was happening. He happened to have had $200 million left in warrants that would have gone down the drain if Goldman Sachs had gone tits up. He was allowed to sell all of his Goldman Sachs stock at a huge profit. I forget how much he made on it. It was an ungodly amount, like, I don't know, 300 million, 400 million, something like that, and not pay taxes on it because of once he became Secretary of the Treasury, he became exempt from paying taxes on it. But he still had 200 million in exposure on warrants. And the story that I had heard that was told by a reporter who happened to have was in the room at the time, when Paulson found out that Goldman Sachs was basically bankrupt, he walked out of the room and threw up in the bathroom. He was so horrified. He knew exactly what was going on. And Bernanke knew what was going on too. Bernanke was nothing but a puppet put in charge of the Fed, and he was just following orders. And now he's going to reap the benefits because he's going to be well paid to go around and get paid $250,000 per speaking gig to tell the stories.
Yeah, that's right. But it's still, all of this begs the question of, well, what was really going on back then that was driving this panic? And the only thing I can think is that there were all sorts of collateral calls on the derivatives. That because everything was going down, the stock market was tanking, everything else, that had triggered whatever clause it was in a lot of derivatives contracts, and a lot of people owed a lot of collateral all at once, and they didn't have it. And they needed cash from somewhere, and I think that was probably what drove it.
That's exactly what was going on. That $700 billion was to plug the derivatives hole that had blown wide open.
And I think that's right. But the point of it is that we're still in that position today. That actually we're in a somewhat worse position because there's more derivatives, and the scope of derivatives that have now been swept into FDIC account, or they've been swept not into FDIC accounts, but they've been swept into institutions that are under the umbrella of the FDIC has increased.
Yes.
And so the situation is actually worse, materially worse now than it was in 2008.
Right. Everyone's worried about bail-ins now because we were told that there would be no more bailouts. Well, they've already legislated a bailout in place when they allowed these banks to move all of their derivative exposure into the holding company, which is covered by FDIC insurance. So even though when the first bank blows up, the FDIC blows up, they're just going to refund that. They'll replenish the FDIC with taxpayer money. Oh, we have to. We're legally obligated.
Europe went the bail-in route. The United States has not yet gone the bail-in route, but it doesn't matter because functionally they have the mechanism here to cover bail-ins is through basically creditor status with your bank. When you go to the bank and you put your $100 in the bank, that's not your money anymore. Your legal status, the minute you tender that money into your bank, you're an unsecured creditor. And so if your bank ever gets into trouble, you as an unsecured creditor will have to stand in line between the secured creditors and the super secured creditors. And the derivatives counterparties are super secured creditors. And that's how, so if a bank ever begins to falter, the counterparty has the right before the bank goes under to come in and grab collateral out of that bank, including deposits. And that law has been in place at least since October of 2005. And actually forms of it started back in 1978. So it's been a long time coming. And Congress could change this, by the way, with a flick of a pen. But they won't do it because they're corrupt and they're bought off.
They are.
All of them. The whole left-right thing is just a puppet show for people who are asleep and absolutely not paying attention to what's going on. If you just look at the FDIC's own reports, called Statistics at a Glance. Comes out every quarter. So each one they have two of them. But each one is a one-page report. You can go and see right now that there's $10 trillion in FDIC accounts, and that $6 trillion of that money is insured. $4 trillion isn't, and that $4 trillion is mostly smaller businesses. That money is as good as gone. That $4 trillion, it's uninsured and it's sitting in FDIC accounts. You might as well kiss $4 trillion goodbye. When the next hiccup in the market comes, that money's gone. And then they'll get to the insured accounts, because the last time I checked, the DIF fund for the FDIC was sitting at about 50 billion. 50 billion to cover 6 trillion. Well, let me know how that works out for you.
One last question, John.
Yes, sir.
Regarding, and this ties into what happened in 2008, and it just happened about 2 weeks ago, 3 weeks ago, with a small bank in Austria. We've already seen the first firebomb to come out of the derivatives that they were holding, and that was a bank in Germany that blew up. And we're starting to see, and I believe, Dave, that you said that was due to Greek derivatives.
Well, the Austrian bank blew up on Greek debt, the German bank blew up because of its exposure to the Austrian bank via credit default swaps.
Sounds remarkably similar to a game of dominoes, doesn't it?
Yes.
Are we seeing the beginning stages of another 2008 with that situation, or do you think that they're going to be able to contain it?
I think they'll be able to contain it for the time being. That's a hard game to play, though. Nobody knows what the black swan event is, and I don't want to get into the dice game of trying to guess which one is the black swan. But there's a black swan coming, and whether it is a bank failing in Austria or butterflies' wings in Japan, or who knows what it could be. Paulson's wife stubs her toe at the grocery. I don't know, but it's coming. And the problem is when the manipulation goes on and on and on and on, the longer it gets, and the bigger the bubble gets, the bigger the bubble, the smaller the pinprick is going to take it down. Remember that. And so because of the smaller the pinprick, there's now instead of 1 million pinpricks that could take this whole colossal fraud down, it's now 1 billion pinpricks, and your odds of being able to identify the particular little, shove that's kind of pushed the canoe over the falls go down. That's a hard game to play, but it could be. The answer is it could be. Anything could be, though. Yeah, there's a lot of bets on this, but people have bets all over the place. In the derivatives market, it's not only that it's unregulated, which is bad enough. There's no transparency. Derivatives are multi, 100-page contracts negotiated between private parties. You don't have access to see what's in those contracts. No one really knows what's in those contracts. And frankly, I find that the disclosure statements in the SEC from these banks about what they're holding derivatives, how would they know? Do they have a team of 10,000 lawyers going through this to report on down to the penny what their holdings and what their exposure is?
No,
I don't know.
Even the banks themselves don't know the real story. I mean, Jamie, when that London whale incident happened, Jamie Dimon had to basically admit as much. He said we don't really know exactly what's going on with the derivatives in London.
Right, and he said that story morphed over time. I mean, the head of the bank is telling you it's $2 billion, and at the end of the day, he finally admitted, well, it was $6.2 billion or whatever it was. That's a 200% error. I mean, that's a really big.
Here's the problem with the derivatives, and I know this from personal experience because when I was a junk bond trader in the 1990s, I filled out ISDA derivative contracts when we would engage in very simple high-yield put-call contracts with counterparties. Okay? And I can guarantee you this is how it works. All of the banks lie to the Fed. Not only that, all of the banks lie to each other. But not only that, all of the employees in each individual bank lie to the people above them in the chain of command. And I know that because we used to lie to our risk management area all the time. all the time with this stuff. So it starts from the ground up at the banks, on the individual trading desks, where you
Right.
lie through your teeth on what you're doing. You lie through your teeth because you're hiding problems. All these banks, every single desk at every fixed income bank, every fixed income desk at every single bank on Wall Street, I guarantee you, is hiding problems. And then it gets magnified because there's derivative contracts that are based on assets that are problematic that are being hidden. I mean, part of the
Right.
reason you do the derivatives is to hide assets. We used to do the call derivative contracts, so that we could take problematic bond positions off our balance sheet right before bonus season, so that we wouldn't have to mark them to market and have a reduced bonus pool. That was going on in the 90s. Imagine how bad it is now, where it's even less regulated.
Right. And that's,
And like I said,
part
this is personal experience. I have personally been involved in this in the 1990s. I saw it happen.
Yeah, and as far as your personal experience is concerned, had you told your risk manager the truth, odds are high he would have told you to lie.
Either that, or I would have been. No, I think in the 90s you would have been fired. Now they would tell you to lie. Yeah, seriously. In the 90s, all this stuff was taken a little bit more seriously, at least by the risk management people. Now no one takes it seriously. They all lie, or they're told to lie.
Yeah,
And that goes all the way to the top, to the Jamie Dimons and Lloyd Blankfeins.
It's
They're
hard
lied
to, see
to,
this
and they
ending
lie to
well.
everyone else.
Yeah. It's hard to see all this fraud and corruption and lying. It's very difficult for me to envision a happy outcome.
There's not a happy outcome, except for the people who have looted the system and managed to get away before the whole thing collapses.
The outcome for them may not be so good either.
Well, that's what I mean. The ones who can escape the country and go away into hiding.
Well, gentlemen, should we wrap this thing up? We're about a half hour into it.
Yeah, sounds good to me, unless there's something else you want to cover.
I think we've covered enough fraud and manipulation and criminal activity for one day.
No, this has been great, John.